Hi, my name is Brenton Harrison, and we're here to talk about 401k loans, how they work, and whether to know if it's something that you should consider when it comes to your finances. Let's get started. At the time of this recording, we're in the middle of an international pandemic. The COVID-19 crisis has impacted so many areas of our life, be it just our ability to go to and fro and socialize with each other, our health, obviously. But another area that's been greatly impacted has been the finances of Americans across this country. You have people who are struggling to pay mortgages, you have people who are looking for just ways to find some financial relief from the situation in which they find themselves. And as a part of an effort to try and stem the tide, Congress initiated and passed legislation called the CARES Act. The CARES Act was a package that had a number of financial measures that were intended to give people who have been impacted by coronavirus some relief, be it in the form of student loan payments, in the form of credit cards and mortgages. But for today's conversation, we're talking about retirement accounts, because one of the elements of the CARES Act is that it increased the amount of 401k loans or retirement account loans that you can take if you're what's called a qualified individual. So when this came out, a lot of people saw that, hey, I can take more of a 401k or a 403b loan than I could in the past. But some of those people didn't know how they worked even before the COVID-19 crisis. So in today's video, what we wanted to cover are some just general topics about how retirement account loans work, why people take them in the first place, and the differences between a typical retirement account loan and one that you might take if you're a qualified individual under the CARES Act. A 401k loan is a loan that you take from your 401k balance. As an example, if you have a $100,000 401k and you take $25,000 as a loan, you now have a $25,000 loan that has to be repaid and $75,000 left in the market. If you're wondering why people take these loans in the first place, it's because they offer an alternative to a retirement account withdrawal. So if you're under the age of 59 and a half and you try to take a retirement account withdrawal, unless it's for certain predetermined allowances, you would be subject to a couple of things. The first is you would be subject to income taxes based on the amount that you withdrew. So in our example, if you took $25,000 from your 401k as a withdrawal, then when you pay taxes the next year, it would look as if you earned $25,000 more than what you did, because that withdrawal is treated as income in the year in which you took it. The other thing that you have to deal with a retirement account withdrawal that's not an eligible allowance or an exclusion is that you have to deal with a 10% penalty. So again, if you take a $25,000 withdrawal before the age of 59 and a half, you would have to pay a 10% penalty on those funds that you withdrew, and you wouldn't get to use all of the money that you plan to use in the first place. So you might have to, when compensating for the taxes and the withdrawal, take $30,000 if you're actually trying to get to $25,000 that you can spend. A lot of people look at that exchange and it's not something that they would like to do. So instead of doing a withdrawal, they access their 401k through a 401k loan. Now, not all plans allow this, but if you do, this is an option that you can consider if you're in a place where you have to decide between the two. This is where it gets a little tricky, because as a part of the CARES Act, the amount that you can take from a 401k loan has been increased for qualified individuals. So we're not going to cover that right now. We'll cover that at the end of the video. But let's say that typically the legislation has been that if you're trying to take a 401k loan, you can take the lesser of $50,000 or 50% of your account balance. Now, what does that mean? Well, that means that if you have $1 million in your 401k, well, remember, the loan that you can take is the lesser of 50% of your account balance, or $50,000. So if you have $1 million in your 401k, 50% of that would be $500,000, but you can't take a $500,000 401k loan. In this example, you would be stuck with the lesser of the $50,000 as the maximum amount that you can take in a 401k loan. Unlike retirement account withdrawals from traditional retirement accounts, loans that you take from your 401k are not subject to income tax. And as long as you pay it back, you will not pay income tax on that 401k loan. But as I say, as long as you pay it back, that obviously leads to our next question. When it comes to the terms, you first have to talk about the repayment period. While you can certainly repay it sooner, typically 401k loans must be paid back within 5 years. So you have 5 years where you have a set interest rate and a set payment, and what your employer will typically do is they'll take that payment out of your paycheck every 2 weeks or every month as you get paid, and as long as you pay it back within that period, there will be no income tax consequence. Now that's 5 years when I say typically, but what happens if you leave that job? Well, what happens when you leave that job is you now have 60 days in which you must repay that outstanding 401k loan. And if you don't, whatever amount you do not repay will now be subject to income taxes. Let's say that we have somebody who had a $25,000 401k loan and they're repaying it back on their 5-year time period. And now they leave that job. And when they leave their job, even though they had 5 years to pay it back, now they find themselves with, say, $10,000 left. And they would have 60 days in which to repay that $10,000. And if they don't, that $10,000 would be treated as income and thus taxable to them in that year. When it comes to interest rates on 401k loans, they can vary by lender. Now, the interesting thing about the interest that you pay on a 401k loan is that interest is actually deposited back into your account. So for example, if you're paying 5% in interest, well, that interest is going back to restore your account balance. And while that may seem like a really positive thing to do, remember that loans reduce your 401k balance. So you still want to do it with extreme caution when you're deciding whether or not to take a loan, because there are times when it really isn't beneficial to have that money missing from the market. But in terms of how interest is charged, it varies by lender, it varies by 401k provider, and that money will technically be deposited back into your own storehouse. The short answer is yes. As more Roth 401k and 403bs are being offered, many of these do offer loan provisions. So if you're wondering the difference between the two, with a pre-tax retirement account, you contribute money that has not been subject to income taxes, and in exchange, when you withdraw those funds in retirement, you pay taxes on the money that you withdraw each year. Well, on the flip side of that, you have Roth accounts, where with Roth accounts, you contribute money that has already been taxed. And when you get to retirement, you do not pay income taxes on the money you withdraw. Roth 401ks and 403bs are a relatively new form of accounts, but they are being offered with more regularity. And if you're wondering if you have one available, you can access or ask your HR provider or your benefits representative. And you can also ask them if that plan has loan provisions that you can access as well. Under the CARES Act, there are what's called qualified individuals. And a qualified individual is simply somebody who can prove that they've been adversely impacted by coronavirus. It could be someone who's been diagnosed as positive, or their spouse has been diagnosed as positive. It could be someone who's been furloughed or laid off or had reduced work hours or reduced pay as a result of the virus. If you're wondering if you qualify, I would encourage you to go to the IRS website to read the parameters or consult with your tax advisor. But if you are indeed a qualified individual, then you are allowed to take the lesser of 100% of your account balance or $100,000 as a retirement account loan in this year. So that means that if you do have that $100,000 401k, then you can technically take 100% of it, and $100,000 would be the limit of your loan. But if you have $1 million 401k, you can't take $1 million 401k loan. You would be stuck at the cap of $100,000. I hope this video was helpful in explaining how 401k loans work, the different provisions that are now available under the CARES Act, and how all of these things can work together when you're making a decision of whether or not it's right for you. My name is Brenton Harrison. If you haven't already, I invite you to subscribe to our channel and check the notifications so that you're notified when new videos are dropped. And we'll try to have more content for you coming consistently and coming for you soon. Have a good one.